SoFi stock is exploding here today. It is going to be our lead subject here at the beginning. We got to talk about what's going on with SoFi. It's making a massive move here today. SoFi stock is now up over 20 percentage points in the past 5 trading days, including up over 10% today alone. I posted this on X, 40% up on SoFi stock already. So we're going to discuss what's going on here in regards to SoFi, why it's so meaningful to SoFi's business model and the valuation of SoFi moving forward. Very important everybody understands that, okay? Then I want to react to this video here, calls of the day, specifically some analyst calls around Tesla and Caterpillar. I want to hear what analysts have to say around Tesla and Caterpillar in this video. Then we'll react to this one. I've underestimated how strong this market's been, says Tom Lee. Tom Lee just went on CNBC 6 hours ago. Now, if you don't know, Tom Lee many times can be very much a perma bull. He went into September, I would say borderline bearish, and especially for him, that was insane. And yet, market rolled in September. Market's been rolling. Here we are in the middle of October. Market just keeps rolling. And even Tom Lee's like, dang, man, I've been too bearish. And so looking forward to reacting to this one, what Tom Lee has to say there. And then last one I want to react to here, the banks are set up pretty well, says Hightower Stephanie Link. Looking forward to reacting to this one because the banking system is so important in the economy. If banks are in good shape, it can set the economy up to be in pretty good shape as well for the future year or two. And the reason being is there's so many businesses and consumers take out loans, right? Very important the banking system is in a healthy spot. So looking forward to reacting to that one in this video here today. Appreciate everybody joining me as always. All I need from you guys is smash that like button, gently press that like button, do whatever you got to do to have that like button glow up like this. And additionally, make sure you subscribe to the channel if you're not here already. Pin comment down there today. What I'm going to put is I'm going to put my X, formerly known as Twitter. I'll put my my X on there, and then additionally I'll put my Instagram. So if you want to follow me on Instagram or you want to follow me on X, either platform, you can follow me on there. If you ever follow me on Instagram, say hello, send me a DM or whatever. I get back to a lot of those there. So SoFi, massive move up here today. What's going on in regards to SoFi? Why is it so meaningful? Well, this is huge in regards to SoFi. SoFi expands loan platform business with $2 billion agreement with Fortress Investment Group. SoFi Technology is a member-centric, one-stop shop for digital financial services that helps members borrow, save, spend, invest, and protect their money. Today announced a $2 billion loan platform business agreement for personal loans with funds managed by affiliates of Fortress Investment Group, LLC. The agreement will expand SoFi's capabilities in its loan platform business, where the company refers pre-qualified borrowers to loan origination partners as well as originates loans on behalf of third parties. SoFi's loan platform business is an important part of our strategy to serve the financial needs of more members and diversify toward less capital-intensive and more fee-based sources of revenue, says Anthony Noto, SoFi CEO. That, very important, folks. Very, very, very important. And I'll explain the details around this in just a moment and why this is so important, okay? And how this really changes the way you value SoFi versus kind of traditionally thinking about it. Anthony Noto says, we're pleased to see continued strong demand for SoFi's loan platform business. Fortress collaboration, seamless execution, and appreciation of the platform's value proposition makes them an exceptional partner. Yeah, $2 billion, it's not a small amount of money, right? As far as what Fortress had to say in regards to this, quote, Fortress is pleased to partner with SoFi to support the growth of the company's loan platform business, added the co-head of specialty finance at Fortress. Quote, SoFi's platform and its focus on innovation in providing valuable credit solutions to its members create a compelling investment opportunity for Fortress's funds. We're excited about building a mutually beneficial partnership with SoFi. So you even see something like this. And you know what I think? Because as Fortress, they manage a lot of money. Like, look at this, $48 billion in assets under management as of June 30th, 2024. So they got a big number here, 48 billion. So you know what I think about when I think about this, and then we'll explain why even this is bigger news. But I see Fortress doing a $2 billion deal here, and it makes me think, who's to say Fortress won't do another 2 billion a year from now, or 5 billion in the future, 10 billion in the future, right? And when SoFi attracts somebody like this, it essentially is like a huge signal to attract other major folks that have a lot of funds around that would, are in this sort of business, right? And so I think this is massive for SoFi's brand as well. It's kind of like when we talk about Palantir, and Palantir lands a big commercial customer, let's say, and then a commercial customer can go talk about how great, Palantir is. I mean, this is the same exact situation. And Palantir can brag about all the money they saved that customer and all the help they provided. This is the same type of situation here. And so I like that. But the thing that's much bigger here, right, was this right here. Diversifying SoFi toward less capital intensive and more fee-based sources of revenue, says Anthony. No, this is so important because if you think about SoFi, like the way I always look at SoFi, is I say it's a bank and it's tech, right? They got their Galileo side, they got their incredible tech platform that they have, right? Awesome. But it's also traditional banking, I think of it as. Now, it looks like Anthony Noto might be wanting to take this company into a more asset-light business, and a more fee-based business, a more where the middleman is going to take cuts of all this, so they don't take as much risk. Now, that's very meaningful because if we talk about you view the company much more as tech than banking, you get a way different valuation. I'll show you that in just a moment, right? But additionally, if let's say you have a viewpoint that we're later stage in the economy, okay? Let's say you have a viewpoint that unemployment is going to climb a lot 6 months from now, a year from now, 2 years from now, 3 years from now, right? And we're going to have some sort of big unemployment-led recession at some point in time, right? And it's coming in the next couple of years or whatever, right? If you have that viewpoint, then the last thing you really want to do is take on much loan business right now, right? That's too risky if you were to go into some sort of big unemployment recession. So if you have that viewpoint, you want to play it cool. You don't really want to do a lot of loan business right now. You don't mind being the middleman and making all the fees on that, right? And so it makes SoFi a less risky business model because you say, what if SoFi just, was a backer of all the loans and they did $2 billion? Well, it's more potential upside from them because then they get to make all that interest, but it's a lot more risk, right? Let's say you take out a $20,000 personal loan at SoFi, right? You get approved for that and it's coming out of SoFi's pocket. All right. If you don't pay back that $20,000, there's no such thing as a free lunch. Somebody's out $20,000. And you know who it is? It's SoFi that's out $20,000. And so that's where you start to begin to look and you say, oof, that's the risky, and that's the problem with these banking companies. And that's why they're valued usually much lower because people understand they're taking on a lot of risk doing all these different loans. It's a lot of risk in that business, right? And so, you can be the middleman, you're just taking fees. Then you're almost starting to become a little bit more like PayPal. And if you remember, PayPal, this is probably, this might be a year ago now, or maybe more than a year ago. But essentially what PayPal did is their buy now, pay later business, that loan book, they ended up selling that off to another company back, it was like a year ago or so, right? And so and it was in regards to their European business. So then they don't have to be the one that's taking all that risk, right? Which is, I think it's kind of a genius idea. Let somebody else take that risk. You don't want to risk your farm. Let them risk their farm for that 10% interest rates or 15 or 7% or whatever they're going to be making, right? But let me show you something very meaningful. And this changes SoFi's valuation in an epic way. So what I want to show you now is I want to go to the compare feature here on 1000X, right? And so let's type in JP Morgan. Let's type in Wells Fargo Company, and let's type in Bank of America. So what are they, BAC? Yeah, they're BAC here, okay? And let's compare these companies, and you're going to find something pretty startling. Check this out. So the forward P on JP Morgan's 13. Wells Fargo, it's 11. Bank of America, it's 12. Banks trade at horrible valuations. They always do. I mean, I almost never see forward Ps over 15 on these type of stocks. No, they're usually anywhere between about 7 and about 14 on these stocks. 7 on the low range, maybe 14 on the high range, but I almost never see forward Ps over 15. They command crap valuations because they take on significant amounts of risk. And so people don't feel super comfortable holding these sorts of stocks, right? And so now let's change it up a little bit. Let's say PayPal, more tech, right? Let's say, and by the way, PayPal's a steal deal. And then let's say Hood, right? Let's compare like Robinhood and check out the valuation of these guys. So PayPal, 18 forward P. Square, around a 17.7 forward P. Hood, 46 forward P. By the way, Square would probably have a lot higher forward P if it wasn't for all their Bitcoin related business. They do a lot of, basically Crypto's important to Square, and some people actually look at that as a risk factor. So that is something to keep in mind. I think Square would command a forward P probably a 30 plus if they weren't so involved in crypto. But anyways, I digress. Like, it's still very important to understand, like, look at the forward Ps of these sorts of companies because they're seen as more asset light than asset heavy like traditional banking. So Hood's out there commanding a 46 forward P. Square's commanding an 18. PayPal's commanding an 18 forward P versus the other guys are at like 11, 12, 13 forward Ps, right? Very important. And so if SoFi can be more asset light and more fee based, there's just always going to command a very, very big valuation on that company because people will look at it as more of a tech company than a traditional banking company, right? So yeah, I can 100% understand why the stock's at $9.99 right now and up 10% plus. Because at the end of the day, by the way, some other good moves out there. Celsius, Elf. Did you guys see the video, by the way, I posted on the main channel? Didn't get the most views. But I posted a video on the main channel probably 4 or 5 days ago now. It was called Buy Celsius and Elf Stock and Don't Stop. I think it was 5 days ago or so I posted that video. If you didn't get a chance to watch it, if you care anything about Celsius stock and Elf stock, you might want to check that out on the main channel, Financial Education, because that was actually a pretty darn important video in my opinion that a lot of people just didn't get to see or whatever. But anyways, look at those ones already moving. They're moving big, fast here. Okay, next one up here. Calls a day. Some big analyst upgrades, downgrades in regards to Tesla, Caterpillar. Then we'll get into Tom Lee, and then we'll get into banking. And I think that's an important subject to react to.
0.4% or 187 points. Just new record after new record. All right. Let's get a little more micro, go through some of the biggest analyst calls of the day. Amgen, downgraded to hold from buy at Truist. Bill, you own it. Does this make you nervous?
It doesn't. I mean, these calls go back and forth. I mean, they're waiting for the GLP. They're Lilly competition here. And in this, if they're able to hit this right, I mean, this could be a $10 billion increase to their bottom line. I like the opportunity here. We're going to continue to own it. It's right in the middle of our pack. So they're going to continue. It's a cycle of analyst calls around this name.
Okay, here we go. Let's talk, Brent, about another energy source, lithium. Albemarle, their target was raised to 100 from 80. The stock by Deutsche Bank, Brent, I don't need to tell you, this stock has really not been able to get out of its own way since it hit new highs 2 years ago. What's your take on Albemarle and this call? What do we do with it?
I mean, the call just says the price should be where it is right now.
I know.
So,
I know.
Lithium, right. So, but lithium spot prices are down 55% over the last 1 year. And so to me, this is about China. And so if you want to play China, historically, China, and Michael Semblis had a really great piece on this, of the BRICS, China.
Whoa. I just looked at something. You guys see Palantir? Palantir's flirting with 44. Oh my gosh, like it's holding the gain so well. You would have thought, okay, it goes over 40, it's going to come right back down. It's holding the gains incredibly well, which means either it's just still a ridiculous amount of hype around Palantir, or maybe, just maybe, they got 30% plus revenue numbers coming, and everybody's about to get their flapjacks flipped here.
Has the worst GDP throughput to earnings. So GDP is growing. It doesn't matter. It doesn't trickle through to earnings. So everyone thinks Baba and JD are cheap. They're going to remain cheap because that does not correlate. Stimulus does not correlate to earnings of these companies because they're a communist regime. But what does potentially go through is the commodity prices. And as China is 60% of EV sales, they are all in. If China does continue this stimulus outside of real estate into the real economy, that could easily put a floor in lithium prices, which then would be a multiplier effect on an Albemarle, SQM, or even like a copper. So if I were going to play China, I would play it through the commodities versus the individual companies.
Yeah, and you're so right about these calls that raise the target toward the stock. It's like the Wall Street equivalent of like lukewarm grilled chicken. Like you don't want it, but if it's all you've got, it's what you're going to do. By the way, Tesla, Bryn, back to you. Reiterated overweight at Piper Sandler. By the way, another call similar. Evercore reiterates in line, but raises their target to 195. But as you can see on the screen, 195, Bryn, is below where Tesla's currently trading.
Right.
So if that was grilled chicken, maybe this is a stale bun. I don't know.
Yeah, I thought that was a misprint, and maybe they meant 295 because they recommended the overweight. You know, Tesla's earnings come out the 23rd. Obviously, the stock had run up significantly going into the 10-10 event. And now we have earnings. The stock sold off. I think people were disappointed on multiple fronts. I think on October 23rd is where we're going to hear the details that we definitely did not hear in the 19-minute robo-taxi review last week. I think they're going to talk about the cheaper car. I think they're going to talk about FSD improvements. And I think that from a technical, the stock has a tremendous amount of resistance at like 265, 275, has a tremendous amount of support at 198, 205. And so I think, watch this stock. If it starts pulling off, selling off into that October 23rd, I think that could be a good buy, a good opportunity to buy in and add to that position.
Okay, here's a call, Bill, where you act.
So here we go. Tesla. You got to keep in mind, Tesla is not a normal stock. Okay. What does that mean? This is what it means. When I say it's not a normal stock, I'm talking about Tesla trades based upon, do people view things as getting better or getting worse? Now, for a while, Tesla was a very attractive stock to buy put options on. I even made money. As of Tesla long, I made a bunch of money on Tesla puts, right? And the reason it was a good opportunity for put options for quite a while there is the story was getting worse and worse and worse, right? The delivery numbers kept getting worse. The production numbers kept getting worse. It was just in this downward funnel to no man's land. That's ended now. The story around Tesla is only getting better. The price cuts days of every second you wake up, you feel like they just cut price again. They cut price again. That's over. The horrible production numbers, delivery numbers, that's over. The Cybertruck is now at a place where it's into a good ramp. It's going to ramp even higher now. But in terms of, I would say they probably lost a lot of money on Cybertrucks for quite a while there. I would say 2025 is looking like a year where they should be able to make significant amounts of money from Cybertruck versus I would say a high probability they lost a lot of money on producing every Cybertruck they produce this year. Whereas next year they should make a lot of money from that. That's getting better. As time ticks on here, we're getting closer and closer to the actual robotaxis being out there, right? And so the bottom line is in regards to Tesla, the story's getting better, right? You might say, it's at a high forward P. When's it not been at a high forward P? Show me a time period where Tesla stock has not traded at a high forward P. It always does. At a high price sales ratio, it always does. It's Tesla. It's always going to command a ridiculous valuation because a lot of people are convinced that Tesla is going to be a multi-trillion dollar company, a $10 trillion company, the biggest company in the world. People are convinced of that. And so they're going to pay up for that stock, right? And until that's ever proven not the case, which it's going to take 5-10 years just to even prove whether that's going to be accurate or not, right? You're going to always have that stock trade ridiculously rich. Would I love to buy Tesla at a forward P of 20 or 30? Sure. But guess what? Everybody would. Everybody would. And that's exactly why I will never trade at a forward P of 20 or 30. Or if it does, it's going to be a long, long time from now when Tesla's maybe growth days aren't there and Elon Musk isn't at the company or something like that anymore, right? And so Tesla, I look at Tesla and I'm like, everything's getting better now. I like those production delivery numbers that came out a week or two ago. Like that was big in my opinion as far as getting confidence back in this company. And, I understand a lot of people wanted more details. I wanted more details on that Tesla day. But the more I look at it, the more I'm like, it's genius to not go as detailed. Because here's the thing. If Tesla goes super detailed on that presentation, then a lot of people starts to get caught up into the micro stuff, right? The details of this and that. Instead, what is the conversation all on social media? It's all about people loving the car, hating the car, the bus, that's the coolest thing ever. People saying, that's so not practical. What happens when it goes over a curb? People seeing the robots and saying, oh my gosh, that's so amazing. And then people saying, well, it's not that amazing because they got teleoperators in there talking. It's not the robots talking. It's all these debates about these bigger, more viral subjects rather than these nitty gritty things about why does the app work like this? It should probably work like that, right? And so instead you're talking about bigger overarching, more exciting subjects that are more likely to go viral, right? And so, it's not like robotaxis are launching tomorrow. So the more I thought about it, the more I'm like, well, do they really need to show off the app and everything and exactly how all that's going to work? Now, they're not launching the product now. Show all that off when you get closer to the actual launch date, when this is a real deal Holyfield and it's in the market, right? So that was kind of my thought around that. But Anyways, always remember Tesla trades more off sentiment than it trades off the financials.
You have a price target that is higher than the actual stock price. That's kind of what we're looking for. Mizuho raising their target on Broadcom to 220, stocks at 181. What do you think?
It's breaking out. I mean, the stock looks terrific. Now, if you look at outside of NVIDIA, it's been the best performing, really, as the largest cap stock within the chip space. But it's the diversification they have as well with VMware, which is more of a subscription business. But you also have the infrastructure spending, the continue that's building out here within that space. So I think that this name is going to continue to rise. And we hold it not only in our main portfolio, but we also hold it in our concentrated portfolio of no more than 10 names.
All right, Steve, you recently dumped out of Caterpillar, Morgan Stanley, downgrading the name. I imagine you're not jumping back in on this one.
No. And as I said before, I think that that's going to be challenging for them to meet all the optimism that's out there in the street. And the stock's not cheap. I mean, when you look at multiples that are low single digits historically, which is where this company should trade at, you say, wow, that's cheap when the market's trading at 22 times. But there are traditional multiples depending upon the sector, depending upon companies. And this one right now, I believe, is overvalued.
Morgan Stanley clearly agrees.
So let me take a peek at Cat. I mean, Cat's such a great company before we get into Tom Lee here and his opinions, perspectives on the market. Cat is such a great company. I mean, truly such a great company. I would love to take a peek at Cat here and just kind of zero in on them. Let's take a peek and see where Cat's at here valuation wise. So around a 17 forward P and 2-year forward P is around the same, right? Next year earnings per share growth, not very exciting. Revenue growth, not very exciting in regards to Cat. So yeah. And the issue is if you have, obviously we're in a higher interest rate environment. Still, we're going to likely go into a lower interest rate environment, but there's kind of a lag there. So you could look at it as there's not going to be as many big projects done for the next 1 to 2 years, right? And so there might not be as much of a need for Caterpillar equipment, but then you have all the government spending on the other side, which is pretty insane. And then just keep in mind, the more Cat machinery that's out there, the more potential revenue they can make off parts. Things go wrong with these things, right? These big machines, and so things have to be fixed if they're out of warranty, all those sorts of things, right? It's coming out of the contractor's pocket. So, and they're kind of a little bit, I almost look at them a little bit as a Boeing, except they actually run their company well, unlike Boeing. But I look at their company as kind of similar to Boeing in terms of they almost have like a monopoly type market share. Hold on. Yes, son? Oh, wow. Jeez, that's crazy. Okay, I'm recording a video, okay? And so I almost look at like Cat as like a Boeing type company, right? Where it just seems like they almost have like a monopoly market share. John Deere competes in this space a little bit in the construction side of the business, but they're not like a huge player. They're more focused on farm equipment, right? And then outside of that, I mean, you've got a few other players here, Japanese company, but I mean, the Cat's the big dog. Cat's the big dog. That's funny. Cat's the big dog. But yeah, do I want to buy it? No. I really don't. Let's take a peek at the charts of Cat here because I am kind of interested to see. I would assume their revenue has been heading up in a nice direction over the past number of years. See, on a trailing 12-month basis. Well, actually, it was heading up very nicely for quite a while, but actually it's downtrended recently, which is kind of intriguing in regards to Cat on a trailing 12-month basis. Wow. I was not expecting that. Earnings per share, trailing 12-month basis, has kind of flatlined as well. Wow. Trailing 12-month free cash flow, downtrended a little bit here as well. So you could look at Cat and you could say maybe this baby's been topping. Shareholder equity topped. Yeah, I want to buy Cat though when everybody feels horrible about the economy, right? I want to buy Cat when we're in a big unemployment cycle. That's when I want to buy Cat. Because that's when no one's going to want to own Cat. When you see unemployment going up, boop, 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 no one's going to want to own Cat. I mean, no one. And that is when you get a special opportunity in the stock. That's an opportunity you could get to maybe buy the stock at $100, $150, $200, something like that. But for right now, all right, let's get into Tom Lee here.
Partner and head of research at Fundstrat Global Advisors, as well as a CNBC contributor. Tom, in recent appearances, I would say that your conviction hasn't necessarily been quite as strong as it had been in some of your other calls, where there's been a time where you said the inflation data will be so good that the S&P will be up 200 points in the next week, and it panned out, and it played right into what you were saying. The last time you were on, I think your basic thesis was that market's still solid through the end of the year, but in the meantime, there could be some volatility.
Last time you were on, literally Tom Lee goes on CNBC like every single week. Like, I'm not joking. Like, do I not react to a new Tom Lee video every single week on this channel? Like, pretty much every single week, I react to a new Tom Lee video. Sometimes it's twice a week. So, yeah.
Maybe even a pullback. Now I think you're saying it's been more stable than what you're expecting, and it has to do with liquidity and cash on the sidelines more than anything else.
Yes, that's right. You're right. We've kind of been sort of, I think, fooled by seasonality because we thought markets would be hesitant before, the elections, and it's October. But we've seen this market be incredibly resilient. So I've underestimated how strong this market's been. I think it really shows macro data is becoming less important, and it's now the fact that a lot of cash has been on the sidelines. For the last 2 years, investors expected a recession, or many thought when the curve uninverts, we got a recession. But at the end of the day, there's $6 trillion of cash on the sidelines, and October has turned out to be a great month.
We've seen it, evidence of what you're saying, and I know how closely you watch it. We've seen it on a daily basis over the last, I'd say, maybe month or so, where many days we're even down triple digits in the futures, only to end up 250 or 300 points by the end of the session. And with no backdrop of positive news, nothing to account for it, other than it seems like there's money on the sidelines coming in.
I mean, it feels like investors are underinvested in stocks. I think there's people who've dreaded 2024, thinking this is the year we slip into a recession, and instead, and we're seeing it with earnings, companies have been really resilient.
Yeah, we waited to retest the lows a couple of times in 2022 and 2023, and people weren't bullish at all. We didn't get great advances, and now it's almost unstoppable, and nothing seems to be able to knock it off a track, whether it's, I think the PPI and CPI were both a little hotter than people thought. The prospects for a Fed continued easing cycle are now open to some conjecture, I think, although most people say it's still going to happen, even though things are pretty solid in both the economy and the stock market.
Yeah, I think it makes sense for the Fed to be dovish just because inflation is still tracking, especially PCE, towards their 2% target. And now we have some concerns about the job market. So I think the Fed has to be supportive. And I think this election, which is becoming less of a coin toss, I think because it's been a coin toss, people have been sitting on their hands. I think these are reasons markets are starting to have conviction, even in front of an election event.
I think we've soft pedaled it too. The swing states have even some of the swing states that looked like solidly in Harris's camp are now truly swing states where Trump's up in Michigan and Wisconsin, and that betting and everything else. And if NBC goes from Trump up or from Harris up 5 to Trump and Harris tied, and then you do a full field and Trump is actually up in a full field thing. So I think you might be right. Bitcoin's at 65,000. You wouldn't say that the stock market's performing better because it's starting to look like it's less of a coin toss, would you?
I think markets like visibility. So if it looks like one candidate is now looking like to be the surprise winner, then markets can actually trade better before the election.
Wait, does it matter? You said markets like visibility. They have to like what they see on the other side of it, I would assume.
Yes. I'm probably just citing market history, but whether Trump or Harris wins, I think stocks do pretty well next year, sort of a post-election rally. But there are definitely differences in sectors and asset classes performance depending if Trump or Harris wins. But, Bitcoin, for instance, is something to watch if Trump looks like he's strengthening because Trump is running on a pro-Bitcoin platform.
All right. Now, you said something, we'll get off of that, the politics. You said that you agreed with almost the asymmetric risk now. And I still think it could go the other way. I mean, I think the labor market looks pretty solid given that last report, and that we're still, if PCE is 3%, we're still, it's got to go down another 33% to hit 2. And they swore they're not moving the goalposts. It's 2. It's 2. It's 2. It's not 2.5, Tom. It's 2.
Yes.
And what makes you think that that's in the car? Who knows with the Middle East and everything else? But oil's back to mid 70s and could go higher.
Yes.
I'm more worried about it. I don't know. They're more worried about the jobs picture than stubborn inflation.
Yeah, I mean, you're actually right. Oil spikes can cause an inflation spike, and that would be a surprise. But if we look at what's been keeping inflation stubbornly high, it's been shelter, which in the latest inflation report finally is rolling over, and it's auto insurance, which is now just beginning to sunset. So in the second half, auto insurance becomes a tailwind. And then the question would be, are core goods going to stay under pressure to kind of bring overall inflation down? And it looks like core inflation, on goods, looks like it's going to remain soft. So I think inflation doesn't have the upside drivers, except for what you're saying, a commodity shock.
Okay, so Tom Lee maybe getting a little more constructive on the market, right? And I will tell you, man, this market's set up to go ridiculously bullish if we keep moving up through the end of this month, right? Then you get the election, and the guy wins that the market really wants that guy to win, right? Gosh, because we know so many people get bullish in general around the market November, December. And then if you have that supercharge, plus coming off of a great September, October, if you're talking about a situation that could just be an absolute melt-up into the beginning of 2025, that would be the melt-up situation, right? Would I bank on that? Not necessarily, but and you could ask me, where do I see the most opportunity if we actually get into a real melt-up, which we're not in a melt-up yet. We're in a great market. It's an uptrending market, but it's this, when I talk melt-up, I'm talking like real FOMO starts to come in the market and everybody starts talking about the market. We're not there yet. We could get there though. But what stocks are going to do the best in that environment? 100%. The Russell 2000. The Russell would just go ridiculous. If we get into some melt-up situation into the end of the year, oh, baby. Because people will look and they'll say, okay, where's the real biggest opportunities out there? They'll look at the Nasdaq at all-time highs. And then you look at the Russell today. The Russell's, roughly around the same value it was 4 years ago. So you look and you're like, okay, the Russell. And obviously that's many times what you see move the biggest. And so if there's a viewpoint that he's getting back in, right? And all of a sudden there starts to be this like FOMO in the market. The Russell, I think, is the one that's most well capitalized in terms of what could capitalize the most on this. I think the Russell could. And so that would be just ridiculous. And you would see the small caps move like nobody's business. I mean, it'd be ridiculous. But we'll see. We'll see how it all plays out, right? There's a lot of different things that could transpire between now and then. But that's a potential. And, just got to be kind of prepared for it, right? Now, it doesn't necessarily mean that 2025 could be a great year for the market, because you could melt up, into even January, and then maybe the market flatlines for the whole year, or even downtrends. Like, these are possibilities that you have to consider. But maybe the biggest gains are just kind of from, let's call it the time things get over there until, let's say, like end of January.
Stephanie Link, Hightower Chief Investment Strategist and a Portfolio Manager. And Stephanie, initially I thought you were kind of messing with us a little bit, because right at the top it says that she's really, really excited about earnings season is here, exclamation point. I'm so excited. Yep. I'm like, that's nice that you're playing along with our promos and everything, because we're trying to get really excited too, but you have a reason for it. Finally you're going to get a break from talking about the Fed. And
one of the other things I think, if you're talking about this like potential like FOMO into end of year, beginning of 2025, just absolute melt up, it would be also, there's one very important company that's going to be reporting earnings that could just add to this huge cycle. And it is actually a big Nasdaq dog. It is NVIDIA. If NVIDIA comes out, and I think there's actually a decent probability NVIDIA comes out and blows out their current numbers expected for this quarter and blows out next quarter. I think this could be the last hurrah in terms of NVIDIA just having that crazy quarter that makes everybody lose their minds. And the stock goes 150, 200, somewhere in that range, right? And then probably ends up multi-year topping after that. But I actually think they're set up pretty well for it. I think they've gotten analyst expectations not to be too crazy. I think they've got the supply. I think they obviously got the demand there. There's no question about that. But it looks like on the supply side, they're looking pretty good. So I think there's a potential they could just come out with an absolute knock it out of the ballpark quarter that would take a lot of people just like, whoa, NVIDIA's really got it, right? And then Jensen just comes on and just lays the hammer about 2025, just going to be unbelievable. Business is exponentially stronger than it's been in 2024 for 2025. Our order book's all built out. We're set to put up massive numbers. We're already taking orders for 2026, which starts to make people feel more comfortable about 2026. That doesn't mean they're going to be comfortable come the end of 2025 into 2026, but it just kind of like sets up the game plan, right? And then, you want to talk about melt up? We can talk melt up. And if you have that going on, you got Meta come out and announce great earnings. Mr. Sofi comes out. Then Mr. Sofi always gets it done. There's no question really there, right? I say Amazon comes out with some great numbers. Whoo. Yeah.
Macro stuff.
Yes.
And delve into the minutia of earnings, and you're welcoming that.
I'm very excited for earnings, Joe. I do not want to talk about the Fed.
I don't want excited.
I don't want to talk about
promos. Get you excited?
I am.
Is that what did it? You watch our promos and you go, "Oh my God, honey, get in here! It's earnings season." Okay.
Yes.
Which
Earnings
one?
season is going to be good. It's going to be good. It's going to be good. We're off to a very good start with JP Morgan and Wells Fargo. So I added actually Wells Fargo into my portfolio on Friday.
You did?
Because I think the banks are actually set up really well. They had very good credit quality. Wells Fargo actually saw a decline in commercial real estate net charge-offs, which that gets me excited, right? I mean, that's the thing that has been bothering me about even the regional banks in general. So they had very good credit quality. So did JP Morgan. They're both talking about a trough in net interest income. So we have to wait for them to see the results in net interest income, probably until 2025. But in the meantime, non-interest income, meaning investment banking, wealth management, credit cards, capital markets, all are actually doing better than expected. And both companies actually are taking share, which I think is a positive. And Wells Fargo trades at 1.3 times book. And we have the asset cap removal potentially coming in the next couple of months. It's been since 2017 that they've had this restriction on asset cap for a while. So I think you're going to start to see a resolution there, and that should be a nice catalyst. So I like the banks. I think they're set up pretty well.
And we're in the end game of Basel III, so eventually they'll be able to return to more normal. And if Wells Fargo can do it, then some of the other names can definitely do it, I guess, that haven't reported yet.
That's for sure. That's for sure. And I like Truist on the same theme, where it's kind of a self-help. They're doing all that they can while they wait for the big bulk of their business, net interest income, to improve, as I mentioned. And so we got some visibility or clarity on when we're going to see net interest income improve. And that's good for Truist because that's 70% of their total revenues. In the meantime, the last 2 years, Truist has actually cut costs. They're focusing on trying to gain some market share. They're investing to grow in the future. And 2025 is a good setup for them because profitability should improve. And in the meantime, they have a $5 billion buyback. And so, again, Basel III endgame, when we get that resolution, we will start to see a pickup in the buybacks as well.
Yeah, so if we have a melt up, what are some of the stocks that are going to perform the most insane that I own personally, right? SoFi definitely would be in that bunch of, if we have a melt up here, don't be surprised if SoFi is $15, $20 before you know it. I do believe Celsius would also see a melt up. I believe Elf would see a melt up. I believe Honest would absolutely see a crazy melt up. Honest was one of the stocks I featured on the main channel, Financial Education. I did a video recently around, what was that video called? 3 stocks with high potential. And if I recall, Honest was the first stock I mentioned there, right? And I mean, Honest's 1 year is ridiculous. It's over 200%, but this could just be the start in regards to that. You could see Honest $10, $15. If we have a melt up, oh my gosh. And then they start coming out with even further upticks in margins and profitability, look out. Like that one will climb like insane. Shopify would definitely see, obviously favorable moves for Shopify and Tesla in that. Fubo would move likely huge. I wouldn't be surprised if that. I mean, if they come out this quarter that they're going to report here, in the next month, and they bring down losses even more, they confirm likely at least one profitable quarter, if not several profitable quarters in 2025. Revenue and subscribers are there, and all of a sudden you get a melt up. So Fubo will be $4 or $5 before you know it. Like that would be insane, right? Which is when it's $1.69. It's pretty sharp move there. So those are some of the stocks I think would move the biggest. I think Revolve and Cake are 2 others that would move big if we get into some sort of melt-up market there. So, no, big question if we get in that melt-up market. But I will say you do kind of have a lot of the ingredients that you need if you're going to have a melt-up market where it's just like, holy smokes, like if you're not in the market, what the heck are you doing?
But besides the banks, do you like Crowd?
Yeah. I do. I like CrowdStrike. I mean, I know it's recovered nicely since it fell 41% since that the software glitch, but it's still down 18%, Joe, from its highs. And it's like the #1 company in the industry, and it is definitely on sale. And I know it's not cheap from a PE basis, but when you can get the #1 company with the #1 product in a cybersecurity, which is one of the #1 themes in technology that I like, I think it's set up really well. What was interesting with their quarter was in the face of the software glitch, they had a 98% retention rate, which is really pretty important, right? Because a lot of people thought the glitch would mean companies would leave CrowdStrike to go elsewhere, and they're not. So you got a company that's growing 40% on earnings and 30% in revenues, and subscription revenues are up 33%. So I think that one is definitely still very attractive.
Yeah, CrowdStrike, they usually have an insane valuation on that company, like insane. Let's go ahead and take a peek here at CrowdStrike. Yeah, 73 forward P on that one. Trailing 12-month P of 461. Yeah, but they're seen as more of a SaaS play, right? And people want to be involved in a stock like this. Just bottom line, like people want to be involved in a stock like CrowdStrike. They look at these type of business models as holy grail business models. Look at the trailing 12-month revenue of this company. Boop, 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 and what's expected here. Boop, boop, boop. And look at the margins of this company, right? What do we got for margins here recently? 75%. Net margins have gone up immensely here. Let's look at a trailing 12-month. Oh my gosh, look at the earnings per share. They went from a big money loser, right, to flipping, now profitable on a trailing 12-month basis, and then it's expected to just explode higher over the next couple of years in regards to their earnings per share. If we take a peek at the trailing 12-month free cash flow, damn, that's impressive. That's impressive. Look at the shareholder equity. Oh, man. And so you can really begin to understand why people are willing to pay very high valuations for companies like this. When your revenue just keeps trending higher and higher and higher and in a substantial fashion, it's not like the growth is slow, it's rapid. And when you have these sorts of margins that are just improving, right? And when you have an earnings per share story that's at the infant stage here, you get it, right? The free cash flow story. This is why people are willing to pay up for a Palantir. This is why people are willing to pay up for a CrowdStrike. The growth rates are just ridiculous.
Though it has had a nice little bounce from its lows.
Chipotle is down a little bit from its highs also, so you buy that.
Yeah. I like Chipotle. This is the same theme. It's #1 in the industry. I think the numbers have been de-risked. They did lower their same-store sales numbers a couple of months ago to about 6.1%. Gross margins are not going to expand as much as people expected because they're not taking the price increases that they have been over the last couple of years. But they're still going to grow nicely, double digits in terms of earnings and revenues. And
we'll see. Don't bank on that. It's definitely a potential, but don't bank on it. I would not bank on it in regards to CMG. There was a potential comp restaurant sales go negative. So once again, I wouldn't bank on it, but there's a real potential here. Free cash flow story has kind of gotten a little iffy here recently in regards to this one. And when she says de-risk as far as the valuation goes, I don't know if I necessarily agree with that. 49 forward P, 42 2-year forward P, it's rich. What happens if comp restaurant sales go negative? What happens if they just are up 1 or 2%? People are going to freak out in regards to stock. You'll see it at $29, $39 quick. So just something to be aware of.
No, everyone's nervous that Brian Niccol left as the CEO, but they have a very strong bench, great team, and I think they're going to continue to do well. So yeah, down 15% from its highs too.
And I think we have time for one more. You like Gap?
I do like Gap, and I've never owned Gap before, but I do think that the company has done a really good job in terms of cutting their inventories. Gross margins are expanding. You have Richard Dixon is the CEO. He's been there since late 2023. Sometimes it takes a couple of months, quarters for a new CEO to really gain momentum, and I think he actually is, and he's hired a new CEO of Athleta, a new CEO of Old Navy. So I think you're going to have a good product refresh. And again, inventories are down nicely, so they're not going to have to mark down. I don't think they're not going to have to. And I think as a result, you're going to see better gross margin. Stock's trading at 12 times earnings with a 3% dividend yield. So yeah, I like that one a lot.
Gap, not a company at all interesting to me. Why? It doesn't matter what valuation it's at. It could be a 6 forward P5. You don't stand for anything. Your brand doesn't mean anything. You're just another clothing company, right? And so I don't want to be in any clothing retailer that's just another company. You got to have something special about you that makes people say, I've got to have that brand, right? That's obviously what Nike has. Like, people go out of their way to buy a pair of Nike shoes or a Nike hat or whatever, right? They go out of their way to make sure they do that. Gap, like, people don't go out of their way to go spend a Gap. It's like, they got a deal going on this week. I'm gonna buy my kids some Gap shirts that they got on sale or something like that, right? Even Lululemon, I look at Lululemon, they got a very special brand. Like, people go out of their way to buy those Lululemon leggings, right? And so you gotta be something more than just a general merchandise type company.
And quite a bit from its highs too, down about 25% or so.
Yeah. So, I mean, I'm just trying to find things that are down, that are not out, but maybe they're forgotten for the time being. And I think all three of those names set up pretty well into...
Which, her mindset right there, that's exactly why if we get into a melt-up situation, the Russell's going to make a ridiculous move, okay? All right, guys, appreciate you joining me as always. Thanks so much for being here. If you're looking to follow me on X or Instagram, I'll put that as a pinned comment down there. If you're looking to apply to join my private stock group, my private wealth group, get access to 1000xstocks.com. Then you can look in the description area of this video. There'll be a link you can click on in the description area of this video to fill out an application to join us on in there. And other than that, much love and have a great day.